Whether you're changing jobs or retiring, rolling over your 401k from your soon-to-be former employer oftentimes makes a lot of sense. But once it's done, it can't be reversed. So in this video, I'm going to explain a few things that you should look out for before rolling over your 401k. And by the way, this also applies to 403bs, 457s, thrift savings plans, and other defined contribution plans. And if we haven't met yet, my name is Jake Skellhorn. I'm a certified financial planner and the co-founder of Spark Wealth Advisors, where my partner Chris and I help people across the country retire with confidence and clarity. Before starting Spark Wealth Advisors, I worked for one of the nation's largest wealth management firms in their workplace retirement team. And during my time there, I literally processed over 1,000 different rollovers for 401k participants. So I've noticed a few common roadblocks and hiccups in the rollover process that you need to look out for, because once it's done, it can't be undone. I can also tell you that it took an average of 2 to 3 or more phone calls for someone to get their rollover done. So hopefully by knowing everything in this video, you can save yourself some of that back and forth in your own rollover process. So with that said, we can start there. The first thing that you should know about the rollover process is that it's typically done by a phone call to your 401k plan's administrator. Some firms will allow you to do it online, but either way, you need 3 pieces of information in order to process a rollover. You need to know how to make the check payable, the account number or the plan number that it's going into, and the mailing address to send the check to. And yes, 401ks, 403bs, and 457 plans are still processed as a physical paper check that's sent to the destination, whether it's an IRA you're rolling it into or another employer-sponsored plan. So you do need those 3 pieces of information. The check will likely be made payable to the name of the institution or possibly your employer. You do not want it to be made payable to your name, because that would be a taxable distribution subject to a 20% tax withholding. So again, check with the gaining institution first to gather that information, and then call your former employer's 401k to provide that to them. The second thing to be aware of is to understand what type of money you have in your 401k plan, and making sure that the gaining institution or the receiving account also accepts that money. So there's 3 different types of money you can have in a 401k. There's pre-tax or traditional money, which is money that you took a tax deduction on when you contributed to it, and then that money is taxed when you take the withdrawal later on in retirement. There's Roth money, which is the opposite, no tax deduction up front, but tax-free withdrawals later. And then there's after-tax, which is somewhere in between. So after-tax contributions are similar to Roth, meaning you don't get a tax deduction up front, but any earnings or growth on the after-tax bucket is considered taxable when you withdraw it later. Most employer-sponsored plans do accept pre-tax and Roth these days if you're rolling it to a new employer. If you're moving it to an IRA, you just want to make sure you have a traditional IRA and a Roth IRA set up to receive that money. What's not as common is that third bucket, the after-tax bucket. After-tax amounts in your 401k are made up of 2 separate amounts. There's the contribution amount, which again is the money that you added to the account, and the earnings. Usually the earnings is going to be lumped into your pre-tax bucket, which is also going to include any company match pre-tax contributions that you made. And then the after-tax contributions will be a separate sort of sub-account that you can convert to a Roth IRA or withdrawal tax and penalty free, since that money has already been taxed. And once again, just remember that even if you only contributed to your Roth 401k the entire time you were with that employer, if you receive any company match from them, that is going to be in the pre-tax account. So make sure you know that before you call in and try to process your rollover, to understand where that pre-tax money will be going as well. Third thing to check for before you process a rollover is to see if you have any outstanding loans on your 401k. Typically, after you separate service from your employer, any loans that are outstanding become due in full within 90 days or so. This does vary from employer to employer, plan to plan, so check your specific plan rules, but typically if you can't pay that loan back before processing your rollover, it will be reclassified as a taxable distribution once you process your rollover, or if the 90 days goes by and you haven't paid it off. So at that point, since it is a distribution, it will be subject to taxes and a 10% penalty unless you separate service from your employer in the year that you turn age 55 or later. This is also known as the Rule of 55, which we'll discuss in just a moment. Some plans will allow you to continue making payments on a loan after you've separated from that employer, but since it's no longer coming out of your payroll, you typically have to send in a cashier's check or a money order, or if you're lucky, you'll be able to link your bank account and make payments via ACH. If you have the option to and you do want to continue making those payments on your loan, you'll typically have to leave your 401k where it is until it's completely paid off, at which point you'll then be able to process your rollover. Before we continue, if you have found this video useful at all so far, don't forget to give it a like and subscribe to the channel for any future videos like this one. The fourth thing that you want to do before you process a rollover is have an investment plan in place for when that rollover check reaches its destination. For rolling money to another employer-sponsored plan, you would definitely want to check ahead of time to look at your investment choices. Sometimes, depending on the size of your employer, investments can have super high fees compared to other 401ks or IRAs, so definitely look into that before you make your decision on rolling it over to a new plan. If you're rolling it to an IRA, remember that this money is cash, so a check will be deposited to your IRA as cash. It's not going to be automatically invested most of the time unless you're working with an advisor or some sort of automated investment platform. So by knowing ahead of time what you plan to reinvest that money into once your rollover check is deposited to your IRA, it can limit the amount of time that you're out of the market and missing any potential growth. Number 5 only really applies if you're planning to roll over pre-tax money into a traditional IRA and you're currently doing backdoor Roth contributions. What I'm referring to here is called the Rata Rule, which states that if you have any pre-tax money in a traditional IRA and you're doing a backdoor Roth conversion, then that money will be considered taxable, at least partially, when you do that second step. So in this case, it may make more sense to leave your money in the 401k or roll it over to another employer-sponsored plan where it's not subject to the Rata Rule. I have done a more in-depth video on the Rata Rule and the backdoor Roth strategy. If you want to check out that video after this one, there'll be a link in the description below. Number 6 on the list here of things that you want to be aware of before doing a rollover is called net unrealized appreciation. I've also done a more in-depth video on this that I'll link in the description below, but net unrealized appreciation really only applies if you hold company stock inside of your 401k plan, and more specifically, company stock that has significantly increased in value. In a nutshell, NUA is essentially favorable tax treatment on the gains of that company stock, where you move it to a brokerage account and sell it there, rather than selling it in a 401k or an IRA and withdrawing that where it's subject to ordinary income taxes. Moving it to a brokerage account first and selling it there would allow you to take advantage of long-term capital gains taxes, which are almost always going to be lower than your ordinary income taxes. So definitely speak to a tax advisor if this is something that applies to you and something that you're looking into, and check out that video if you want to learn more about it. And last on my list here is if you're retiring between the ages of 55 and 59 and a half, before doing a rollover, you definitely want to learn the ins and outs of something called the Rule of 55. And essentially what that states is if you separate service from your employer in the year that you turn age 55 or later, any withdrawals from that 401k specifically will not be subject to a 10% early withdrawal penalty. The reason I bring this up is because a lot of people default to rolling their 401k over to an IRA when they retire, even if it's early. So let's say you're age 57 and you separate service from your job, and you want to roll this money over to an IRA where you can start taking a monthly withdrawal from it. Because the Rule of 55 does not apply to IRAs, withdrawals from that account would be subject to a 10% penalty, whereas they would not if you had left it in the 401k. The Rule of 55 also has a lot of nuance. It does depend on specific plan rules. I did this video where I go into a deeper dive on the different ins and outs of the Rule of 55 if you want to check that one out now. Besides that, all the other videos we mentioned throughout this one are linked in the description below. Don't forget to subscribe if you enjoyed this video or found it helpful, and we will see you in the next one. Thanks for joining.